Hi, I'm Bob French. Through the end of the first quarter of 2020, the markets have been choppy, to say the least. And it's making a lot of people really nervous, for very good reason. The effects of COVID-19 have caused the markets to drop in a truly historic fashion. This is scary for a whole host of reasons. But even during a regular downturn, it's normal to get nervous. Frankly, it's a little weird if you don't. For most people, they need decent, if not good or great returns from the financial markets to get where they want to go in retirement. Now, we can have a conversation about whether that's actually smart or not, but either way, that's where we are. So again, it's normal to be nervous during any period where the markets are whipping around, especially when they seem to be whipping down a lot more often than up. Now, everyone knows they're supposed to be disciplined investors. You're not supposed to pay attention to what the markets are doing on a day-to-day, week-to-week, or even month-to-month basis. But during the worst of what we were seeing, I was glued to the stock ticker, just like everyone else. You're supposed to design your portfolio so that you can ride out whatever the markets throw your way, especially in the short term. To be blunt, this is really hard, especially in the middle of a pandemic. All of this said, though, you probably do want to stick to your plan, assuming that you put in the time to develop a retirement income plan that matches your risk preferences and needs, and especially takes into account your investment risk tolerance. In my first job out of college, I worked for a mutual fund company, and the head of the group I was in used to be a broker in the bad old days, as he liked to say, and he really liked to tell stories. One he told all the time, especially since I was working for him during 2008 and the Great Recession, was how he would handle one of his clients panicking during a downturn and wanting to sell out of all their stocks. He would sit them down across the table and commiserate with them about everything that was going on and try and gently talk them back from the edge. But when that didn't work, he would calmly take out a piece of paper and slide it across the table. And on this paper was a letter that he would ask the client to sign, stating that if they sold out of their stocks now, they just couldn't stomach the risk of investing in stocks. So they would never buy any stocks ever again. Now, this guy's stories were always a little too perfectly on the nose and somehow had the habit of slightly changing to fit whatever situation he was in. Though this one does feel like something he would have done. And now that I'm telling this story, I'm not sure why I'm referring to him in the past tense. He's retired now, but he's still around. The point he was trying to make is that stocks go up and down. When you invest in the stock market, you need to expect that. And if you can't handle a serious downturn, then stocks might not be the right investment tool for you. If you've seen anything that we've ever put out, there's a very good chance that you've seen this chart. This is the fear versus greed roller coaster. We talk about it all the time because it's a crucial concept. When things are going well, people get overconfident. But the market will eventually turn around. It always turns around. And as the market starts coming back down, people will get more and more fearful. But the market will eventually turn around. It always turns around. Most people are continuously on this cycle. And think about what it does to you. Most people buy high and sell low, which is not quite what you want to be doing. You want to be able to stay disciplined no matter what else is going on in the markets. You want to stick to that boring dotted line in the middle because that is what's most likely to get you where you want to go in retirement. But it's actually pretty rare for someone to tell me they just want to get out of stocks. What they want to do is shade their allocation one way or the other. Because we actually get a lot of people asking if times like these are the right time to put their money to work and increase the level of risk in their portfolio. But either way, my answer is pretty much the same. Probably not. And as you might imagine, that probably is doing some work here. To be clear, when I say you should probably stick to your plan, what I mean is that nearly everyone should hold off on making any changes to their asset allocation or retirement income plan when everyone, for good reason, is freaking out about the markets and the broader economy. But it's not impossible that you might be the exception. So what does that exception look like? Well, just like the financial markets generally, you're always absorbing new information. And the relevant information for this is what you're learning about your risk tolerance. During normal times, we're guessing how we'll act when the markets start making big moves either up or down. And these are generally pretty good guesses. We've all lived with ourselves for a while, and we kind of know what we're about. And we can also look at how we've acted during past downturns. But we're still making guesses about how we'll act in the future, especially if your financial situation has changed substantially in the past few years. When we hit a bad market, or a really good market, we're now getting a lot of information about how we really feel about risk. Does it feel as bad as you thought it would? Better? Worse? No matter what, this is a good time to reflect on your reaction to what the market is doing, even if you aren't having any thoughts about changing up your plan. Your reactions in the middle of a big market event are really important pieces of information about how you should act in the future when it does come time to reassess how your plan is put together. Again, for 999 people or more out of 1,000, the best answer is to sit still and ride everything out. Dealing with bad markets is part of the process of harvesting the long-term returns that the financial markets offer. If it were easy, those returns we're all looking for just wouldn't be there. But once in a blue moon, making a change might actually be appropriate. It probably isn't, but maybe. Just be super careful about the changes you're considering. If you're looking to add stocks because everything up until this point just hasn't fazed you all that much, well, there's no guarantee that the markets won't keep dropping, and you'll just be leaning into that punch. If you're thinking about selling out of stocks, I might just have something for you to sign. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this, or if there's any other questions you'd like me to address, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.